to a really great financial future. Tom and Don are talking real money.
You know, I think the biggest surprise that I have had with aging is the weird time compression that I don't think I had ever expected. And by that, I mean, when you look back at events that are very clear in our older memories, they don't seem like they were that long ago. And yet the event we're going to talk about here happened prior to anybody age 30 or younger even knowing it happened.
Take a guess. Today I brought it up in our all-staff meeting, and there were about 25 people there. Guess how many people remembered what we're going to talk about? How many hands went up?
I'm trying to think of. You have a couple of old people. Up. You have a couple of old people, so probably
There's
three
hands. Three.
Yeah.
Nobody else in the room.
And I know who. I know who raised their hands. Yeah.
It's like, wait a minute.
It's the 30-somethings and younger who don't know this. As a matter of fact, the 20-somethings don't even remember 2008.
No,
they don't. It was something those old farts talk about. Well, welcome to Old Fart Radio. I'm Old Fart Don. That's Older Fart. No, I'm Older Fart Don. That's Younger Fart
it's
Tom.
It's close enough. So
and it's close enough. And welcome to the
right.
Talking Real Money. Wow, is this exciting podcast. Doesn't get any better than this. What are we talking about today? Well, lately, what has been the hottest segment of the U.S. economy, certainly, and really the global economy? When you look at stocks in Taiwan and South Korea and Europe too, a lot of what's been happening in the market is driven not just by technology, but by the potential of artificial intelligence, which I have to tell you is legitimate potential for improving productivity. I'm with Elon Musk on this one. I'm not with him on much, but AI could be the global savior of productivity. So, with that said, there's a lot of concern, Tom, about
there's concern because
what's going on.
Well, because when things go up the way they have, trading on the AI trade, and if you consider the Mag 7, for example, to be reflective of that, because they're spending billions of dollars there, there's worry that we're in, I hate to say it because you never know until afterwards, the bubble. Yeah, exactly. So a lot of people, thank you. That's much better. There's a lot of people writing about this, and our friends at Fidelity that write a lot. They do a lot. We'll talk about one of their wonderful puns.
They got people just sitting around who write for a living, or it could be AI.
It could be. So it could be AI. That's good. So there's a paper they just wrote about the 5 signs of an AI bubble to watch for. I didn't know about this until our friend Paul Merriman published it in his newsletter. So I read it a couple of times because I'm interested. And as you'll hear at the end of it all, it doesn't change what I believe about investing, but I think it's an interesting thing to consider. And the comparison is, are we in a bubble today with AI? And I think Eugene Fama put this correctly. You never know when you're in a bubble until you're out of the bubble. Then you knew you were in a bubble.
You don't know you've been in a bubble until the bubble.
Yeah. Thank you. Much better. And the comparison is to the, .com craze, right? The thing Don just mentioned.
2000.
So many people don't remember, which, I can remember well.
My daughter was 5.
Yeah, okay. I have one not alive yet. Anyway, 6. AI that could lead to productivity gains and making labor and capital more efficient, higher profits. And Fidelity says they still believe that to be true. They still think AI at the end of the day, that's what will happen. But they got into some of the specifics about the factors you should look at today if you're really worried about this, the things they think you should consider, right? And they have some sub-headlines that say why the end of the AI trend does not appear to be imminent. They go into very specific items on stocks that you and I do not spend time on because we buy markets. We sometimes sell them when we're rebalancing, but that's it. We don't get in and out based on trends or based on feelings or based on any of those things.
Yeah,
and that's what we're talking about.
We're not watching individual stocks and going, "Oh, that this is a buy at this price."
Yeah, real opportunity. So, okay, but they go into a few things, and just for purposes of discussion, but also purposes of education, we can talk about them. Earnings growth. The S&P 500, they say, S&P 500 index appears on track for a 10th consecutive quarter of earnings growth. Let's see. So
when earnings grow, the companies are making more money, and therefore, generally speaking, they become more valuable.
Generally, yes. Generally. Not always, but generally. And by the way, they also point out in the article at the Mag 7, which, I'm going to belabor this. We're going to Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Broadcom. Right? That's right? So,
is Broadcom in there?
That's what they mentioned. 1, 2, 3, 4, 5, 6, 7. That's what they mentioned. Anyway,
Broadcom. I didn't know Broadcom was in there.
When I read it, I was surprised too. But they point out that in June, those Mag 7 stocks lost 9%. And this is being recorded basically in the middle of July. So far in the middle of July, or late July, I should say, they're up about 4%. They're down 9%.
I asked AI, by the way.
Yeah. Not happening.
No, AI says Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla.
Yeah. So I guess Tesla and Broadcom are battling it out for place number 7. So again, but back to then they talk about not just earnings, but the quality of those earnings, which again, I hate to boil things down, cash flow versus earnings, aggregate margin, things that I don't think you need to worry about as an investor. But here's one that is worth considering, not making a change in your portfolio, but valuations versus history. This comes up a lot. You hear this a lot in the media. You hear a lot of discussions about the fact that stocks are kind of expensive. Mm-hmm. At the end of 2025, the S&P 500 traded at 22.3 times forward earnings. Remember, what people are expected to make.
We think they're going to be.
They think they're going to be. This gets me a little shaky, which is above its 10-year average of 18.7. That's quite a bit above. I mean, that's 4% above the average. So that's, what's that?
20%.
Yeah, it's not insignificant. And they say that the only time you can look back and see this is one of them is the July 1999 peak of 24.4 times. So if that scares you, maybe the next one will scare you more. And that is around capital spending. This is the thing that, remember we read the piece in the Wall Street Journal about how more is being spent on AI than was on like the railroad to get all the way out here to the west, the highway system. I mean, this is a major, major, major expense. So there's a lot of money being thrown at this by companies. They call it CAPEX, right? Capital spending. And can they afford it? Because remember, they're borrowing money to do that as well. And how that will all end up, that's something worth watching. Again, these aren't things I would trade my portfolio on, but I think it deserves a watch. And then the one that I really think is a concern, the rate cycle. The connection between Fed hiking cycles and market bubbles has often followed, this according to Fidelity, a predictable pattern. Bubbles have burst.
I hate that word. Wait, can we go back?
Bubbles have burst.
Predictable pattern.
There is no predictable pattern.
There's no such thing as a predictable pattern.
No. But they say bubbles have burst following extended periods of excess liquidity, most often after an era of low rates. In other words, excess liquidity
a lot of people have
leaves
a lot of
hangover. Markets decline later. It's part of what they used to call the economic cycle, right? And like things go up, things go down. I think we did a chapter on this from your book.
Now they're all e-bikes. So
they're all e-bikes.
Oh, wrong kind of cycle. Sorry.
Exactly. That's the only type I ride. So, okay. But at the end of the day, Fidelity says, we don't think we're in an imminent bubble. AI remains in an early, they call it, economic development stage, and they believe balanced exposure to fixed income is important. They throw that in at the end because I think they're doing a little CYA action there in case things do blow up. And they say, well, but we told you to own bonds. But what's my takeaway from this? Well, my takeaway is, number one, you may have heard this previously, stay diversified. Because if you're just in these 7 stocks, you could be in for, or if you're just decided to bolt in, because you were picking on me recently about telling people to own emerging markets. You should own them all the time. But people are running into them now because they're up 16% year to date.
Right. Yeah, because it's the hot thing. No,
that's not the way to do it.
Not the why.
Stay diversified. So you still own those. Maintain is a hard one. Realistic expectations. Look, stocks have made a lot of money the last 3 or 4 years. A lot of money. And that gets people overconfident that they're going to continue to make that year after year. They won't, and you should not expect that. And then the other one that you and I spend a lot of time on because it's very difficult investor behavior, and that is keeping disciplined. You don't change your discipline because something's happened. You don't make a move because you think something's going to happen. You have a plan, you have an asset allocation, and that's where you're at. So this is an interesting paper. I think it's available. I think anybody can go read this online if you really want to dive into what the future could look like.
You got the gist of it here.
You got the good gist.
Here's the thing about us. We're weird. Well, we're weird. We're predictable. The market, as you said, has done very well lately. The returns, particularly on those Magnificent Seven stocks, and by the way, Broadcom is kind of being inserted once in a while because it has a higher market cap than Tesla right now. And
okay.
So. Anyway,
why don't we just make it
here's
8?
The problem is
grade
that
8.
People look at their portfolios and they go, "Whoa, I'm way up lately. I want to just keep all that profit, and I don't want to lose any of that profit. So I want to get out." And then I'll get back in after it goes down because you're greedy. That actually is a sign of greed. It's truly what it is because, okay, great. The market returned lately, let's just say 20%. Market's average is 10. That means that you're going to get at some point a reversion to the mean to get you back to that average annual 10. You don't want to give up that decline. Can't blame you. But it's very French Revolutionary, and you can't have that cake forever in your wallet and get to eat it.
Hard to swallow without your head, turns out.
So it's
just tricky.
You can't. I guess the best song. You can't always get what you want.
Ooh, bringing the Stones in there. I like that. That's good. So,
but sometimes you get what you
get
need.
no satisfaction would have been my pick.
You generally don't. So
exactly. So I mean, this is. Interesting topic to be continued, but again, if you have the right asset allocation, as some of you do and most of you don't.
Some of you do.
Because I look at this every day. I just looked at a portfolio where this isn't somebody's retirement account. It's the S&P 500 for 30% of it and then about 8 individual stocks that are all in the S&P 500 for the rest of it.
That's not an asset allocation. Then.
That's not an asset. Well, I guess it is an asset allocation, but it's not a very good one.
Dangerous.
Put it that way. Yeah. No bonds. Person's in their 70s. No bonds.
Now, let me tell you, something happened recently, not too long ago. Tom got back from another vacation. And when Tom gets back from vacation, Tom actually goes through some of the questions. And he gets on the phone with you. And then he records those questions, so it kind of sounds almost like a live talk show, even though this is a recorded podcast. And look, he did one just recently.
Let's go to Connecticut, where we talk with Josh here on Talking Real Money. Hey, Josh, how are you?
Good, yourself?
Doing great. Glad to have you on the program. So what's up? How can we help?
So you guys talk about the flexible 5% safe withdrawal methodology regularly. And so just my understanding, if you've got enough, pensions and annuities or whatever that you could live on zero, you're absolutely flexible. So 5% will definitely be good and it'll last forever. If you have, if you need 4.9% of whatever your starting amount is, then you have very, very little flexibility, and the flexible 5% is probably not appropriate for you. Sound about right?
Yeah, this is always the number one question, always the number one issue when we meet with people. Do I have enough? Is it going to last? And it's a fascinating topic because most people who are like you, who have thought about this, have a tendency to underspend. There was a piece in the Wall Street Journal, I think about a year ago, talking about the people that are savers and investors generally don't run out of money because they're conscious of these things rather than somebody just sort of says, I have all this money, I'm going to go spend it. Number two is, while we talk, and what Josh is talking about here is the withdrawal rate, a percentage of your portfolio you can pull out and still not have it run out. And I think Christine Benz, who's kind of a friend of ours, writes at Morningstar, she once said the only correct withdrawal rate you'll know is after you're gone, which is kind of unfortunate. So what Josh, again, he's wondering if 5% works in every case, and the reality is no, it doesn't.
So my question is, we know that if you could survive on 0, you're obviously flexible enough, and it's pretty obvious that if you need exactly 5%, you aren't flexible at all, so a flexible 5% withdrawal rate is not appropriate for you. What I was wondering is, are you aware of any studies that determine where the line is? What amount of flexibility is required for a flexible 5% withdrawal strategy to be appropriate for you?
Yeah, so how much less you can take and still have it work.
Exactly. Yeah. I had ran some simulations, and it was looking around, 2.5% to 3% of your initial. If you would be happy with that, then the flexible 5% has basically 100% chance of being fine.
Yeah.
But above that, you start to drop. I was hoping that there were some studies I could compare my results to.
Yeah. The short answer is probably not. I've never seen that. There was a piece. I'm trying to remember who did it. I mean, for people that are do-it-yourselfers, we send them to Bolden or Projection Lab or NerdWallet, one of those online calculators, which are pretty good. They're not as good, I don't think, as the stuff that we do, because we're just spending more time on it. We do it every day, and we can do it a little bit better. But for somebody who just wants to kind of run it, see how am I looking, and again, the problem is for me to get on the program and say this will work for everybody is that every person's situation is idiosyncratic. Josh's is different than Tom's, is different than Don's. So there really isn't one number per se. And again, when we run these things, we run, I think it's 1,000 trials or something, with the Monte Carlo. So and then we could run it again and say, okay, we have horrible markets for the next 10 years, and then they're okay after that. How does it all work? Because as you know, much of this is dependent on, good returns, okay returns, great returns, whatever it is for a long period of time. If you retired in, the summer of 2008 and started pulling money out for the next couple of years while the market was down, you may have to reduce your withdrawal rate substantially in the next couple of years because you've lost so much money those first couple. So, yeah, I love what you're saying. I like what you're doing. Again, for us, when we do actual planning for people, we put in you mentioned the variables, the pensions and Social Security and savings and all the rest of it. And we'll run that number over and over and over and over again and put in other topics that may come along with long-term care issues or whatever comes along, and then look at it. And even then, I don't know that I trust it because there's just so many variables outside of our control. We can tell you what the range looks like and the percentage of success, but I don't know of any actual study that says if you're going to try to do a variable withdrawal, here's the minimum that that we know it will work into the future, because I can't even make that guarantee to the work that we do individually for people. There just is no real guarantee in life on this stuff, unfortunately.
Oh yeah, so never a guarantee. I was just wondering if there was a study about where it starts to.
Yeah, I'm not aware of it. I'm not aware of that. It may be out there. Again, the work that I know the great advisors do is they plug all this in, they run it, they rerun it. They'll run it again in 6 months. Obviously, when they meet with somebody, they run it again when they meet with them the next year. But there isn't a study I've seen per se that will give you that number.
That was my question.
Yeah, it's a great question. Again, I love the fact that you're thinking about it, and it suggests that your retirement is going to be just fine.
So say the numbers that I've run.
Good for you. Well, and the fact that you're designing your own work and really thinking about it all is awesome. So, hey, thank you for listening, and thank you for being part of the program.
All right. Thank you very much.
Thanks, Josh.
And while those are great fun, we also have a good time when Tom reads his favorite little paper questions, and we still have a couple of those before we run out of podcasts, don't we?
Well, I'm more worried about running out of trees now because things have been dry here for a bit, and I don't know, they're not looking too good. So,
well, you can certainly have one of mine. They're way too big. I got to cut them. I got to cut limbs off of them really soon for $5,000.
Yeah, if anybody wants to make a bid on Don's tree trimming, please contact Mr.
$5,000 to trim 1, 2, 3, 4, 5 trees. $1,000 a tree.
Those are big trees. Those are big trees.
They are. Well, it's Florida.
Yeah, everything grows.
My 30-year-old trees look like 100-year-old trees up north.
crazy. Yeah.
Or more.
Everything
Anyway,
grows.
so
All
what do
right,
you got?
let's go to the
What's
questions.
in
We got
paper?
a couple questions. We'll get a couple of them here. Richard from Edmonds, Washington writes, "Hello, gentlemen. I'm 63 and received my annual Social Security statement showing the ladder of how my benefits will increase the longer I wait up until age 70. But reading the fine print, it says as long as I keep earning my most recent salary of $82,000 a year. Well, this is my 2024 salary, and I retired in early 2025 and have not had a salary since. We're currently living off my wife's salary and a little of current savings to keep the life we want. She will work until I'm 65 for Medicare, then retire herself. You've always said to wait until 70 to receive the 8% a year increase, but would this hold true if I'm not going to be working in those years? Am I leaving money on the table by not taking it earlier if I'm not going to be adding additional yearly earnings to the pot? Should your advice be to hold off as long as possible, as long as you keep working? Love listening to your podcast while walking the dog."
All right.
I hope Rover enjoys it too.
Here's the thing.
It is reduced.
Here's
yes.
what happens. Your earnings, Social Security, they say that because that's their CYA thing. Because it can change if, and here's the big if. And you can look back at this, by the way. It's on Social Security.gov.
SSA?
SSA.gov. You can look back. It's based on your highest 35 years
That's right.
of earnings.
Yep.
So if you have 35 great years, a few years in retirement will just do nothing. Now, if you have fewer than 35 years, when you miss years, then that lowers the calculation.
Or if you have a zero in there. I have a zero in one of my years.
Yeah, so that gets rid of, that gets rid of one of the years. But
Yep.
it's based on the 35 highest earning years. So if you had 35 good years, then you're good.
Yeah. It does make the assumption that you will continue to work. So it will be a little less than you would thought at 70, but not much. Not much. I've seen this because we've gone through this with people before.
Yeah, it's
Stick to your guns.
Yeah, I mean, let me hold on. Let me pull up. Oh, this is from SSA. Hold on.
Yep.
If you were born in 1960 and you had a full retirement age of 67 and you stopped working at 64, lived on your savings for 6 years and claimed at 70, your earnings-based calculation could be a little lower depending on those 35 years, but it's still going to be 24% higher than your age 67 amount.
Exactly. You still get the 8% a year. But so in his case, I'd hold out for the 70. Remember, by the way, the reason we tell people that is not just because you're going to get a bigger benefit. If the other person in your household is less, no matter whom survives, you or your spouse, that person will get the bigger benefit for the rest of their lives. It's very important concept.
And so for men particularly,
'Cause we're all gonna be dead
delaying
soon.
makes more sense.
Yep, it really does.
We tend to die sooner.
Yep.
So if
And
you have
listening to the
equal
show
age
is a good thing.
spouses, the wife is likely, the odds, the actuarial tables say your wife is going to, unless she earned more than you, if she earned less than you and had smaller benefits, she's going to really appreciate you waiting later on in life.
You know how excited she gets when you say that? She just loves that.
Your wife?
Yeah, when she hears that I'm going to die soon, she just thinks that's great. She just gets all worked up.
She's counting the money. She's got the abacus out.
So damn rich. All right. Bren from Chicago. I'm kidding. Bren writes us from Chicago. In a retirement-oriented portfolio, I'm assuming that means like an IRA or something.
Yeah, probably.
Yeah. We now have some inherited FCVSX.
SCV.
Frank, Charlie, Victor, Sam, X-ray. New to us. Wondering what about more about convertibles, not the driving type. Thoughts, insight on it, or an ETF like ICVT, the iShares Convertible Bond ETF.
Okay, why do you want convertible bonds?
I don't. But explain what that is first. This is debt issued by companies that can become stock. Correct?
Yeah, it can.
Right.
It can. It may not.
I know.
And generally, companies issue this because they have a need for flexibility and don't want to pay higher rates because they're not in the best shape. Okay, let's go back. Let's go way back.
The fund.
In time.
Yeah.
Let's
what about
go back
the
to the
fund
fund itself. Fidelity Advisor Value Fund, Class C. Now, if you've listened to the show for any time at all, we haven't discussed this in a while because these things are getting sold less and less and less every day. A Class C share is a type of mutual fund that I call a liar load fund, or the former way back chairman of the SEC, I think it was Chris Cox.
It was Chris Cox.
Called a sales load in drag fund.
You love that one.
It's a sneaky way of charging you the full 5+% commission by the seller, but you not seeing the immediate decline in value that you would see from a 5% commission, like $10,000 suddenly becoming $9,500. You don't see that big decline because instead of charging that commission up front, they charge it every year, in some cases forever. And the expense ratio of this Fidelity fund reflects that at
it becomes part of the expense ratio.
It becomes part of the expense ratio. This is so ludicrous to pay.
How much?
1.84% per year.
Which is that's 2%. I mean, that is outrageous. It's outrageous in any world, but especially today's world where you can buy the Vanguard Total World Fund for 6 basis points. That makes no sense.
Okay, so you don't.
Okay, but what about?
So don't replace it with another convertible bond fund, even if it's better.
I'm trying to understand why you want to own that.
What's the symbol of that other one? I didn't get that one.
I C. Yep. Victory Thomas, VT.
Victory. You love saying Victory Thomas, don't you?
So, I mean, again.
iShares convertible bond ETF expense ratio. See, here, 0.2%.
Yeah, much better than the other, that's for sure. But I don't know why
still,
you have to own convertibles.
Here's the thing. Convertibles tend to be lower quality paper because that's one of the reasons they issue convertibles. 2, they're complicated. They're safer than common stock, but not much. So there's really no safety. They're illiquid as all get out. When they convert, they dilute the existing shareholders, which really drags down the price. There's no benefit for individuals owning convertible. There might be some benefits for major institutions owning them, maybe as part of their weird, wacky portfolios. But for you as an individual, no. Just own a well-diversified stock and bond portfolio.
No. So clean that up. It's in an inherited IRA, it sounds like. Easy to sell that, build the right portfolio, and get on with your life.
And if it's just inherited and not in an IRA, remember, if it was just inherited, recently inherited, you get a cost basis step up. So sell it. Get out of it. Get rid of it. Oh, why would anybody pay Fidelity 1.84% per year?
I think Fidelity should be ashamed of themselves.
Fidelity wanted to be all things to all people. That was the one thing I didn't like about Fidelity is that they were whoever wants to sell our stuff. Yeah. Brokers, no load, index, manage, we'll be whatever you want us to be. We're Fidelity.
That's pretty good.
Yeah. We'll be whatever you want us to be. We're Fidelity. Anyway. Thank you. That's it. That's all. You could have done another question.
No, I couldn't.
Okay, we have time.
I'm tired and I need a nap after all this. So,
even I don't need a nap that quickly. This is worrying me. I think we're losing Tom. He's slowly drifting away. Bye-bye. Well, thank you all for listening to the podcast. Hope you do it again sometime, like maybe tomorrow. And would we appreciate it if you tell people about us? That is really cool when you do. We just love that. Sharing the love or spreading the word. And, by the way, if you need a little bit of help, you want to talk to a fiduciary advisor and you don't want to get sold stuff, you don't even want to pay, okay, we'll do that. It's called pro bono work. We do some of that because we know that sometimes you just have a question or you have a portfolio, you're going, I don't know if this is right or not. I wish somebody would give me another opinion without trying to sell me on their services. I know a company that'll do that. It's called Appella. We have a number of very fine financial advice people who will do that for you, fiduciary financial advice people for free with no obligation. And I promise you, no high-pressure sales pitch, and one of those is Tom himself. So go to TalkingRealMoney.com, click on the button that says Meet an Advisor. If you have questions, go to Ask a Question. And If you want them answered, you want to speak them in, you don't want to type them because that's a lot of work for people like me who don't like to type. Speak them at talkingrealmoney.com using the little mic button in the corner, and those will go on the Friday Q&A podcast. So there you have everything. Thanks for being there. Thanks for listening. Thanks for sharing. Thanks for caring. I'm Don. That guy's Tom. Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.